Robert Prior Head of Asian and India Economies at Credit Suisse, that is CS, joins us live from Singapore. Robert, fantastic to have you back on ET Now. Thank you for joining us. Robert, let me just pick some words from Janet Yellen's testimony last night and throw them at you. Asset purchases are not a preset course. You cannot blame everything on weather when it comes to the January economic data, and unemployment is not a sufficient data to consider tapering. Is she now sounding very dovish?
I don't think any of those comments were particularly new, actually. And in some ways, I think they are quite selective. I mean, there are other comments that were certainly more balanced than that. And I think overall, the message was that we're still headed for another 10 billion taper at the March 19th meeting, so down to 55 billion. So I think she also indicated that the economic numbers would have to be probably quite a lot worse than they've been so far to stop that process of tapering.
So what is the excitement all about if, according to you, last night's commentary is nothing new and was on expected lines? What explains the underlying price action and the underlying momentum in equities?
Well, I think maybe what we're seeing here is a market that is now comfortable with tapering, and that in itself is quite reassuring. We're not seeing the same sort of slightly panicky reactions, even in most emerging markets, to the prospect of ongoing tapering. It's, as I say, I think largely priced in. And obviously we also had some reasonable, or certainly better than expected, durable goods orders numbers last night as well. And that would have reassured many that the US economy is certainly not falling off the edge of a cliff in the first quarter.
Robert, what is it that you're sensing about India? Because it's gotten a pretty range-bound market, and the flows as well have been pretty, they've been dragging and lackluster.
Yes, it's not the most exciting of markets right now. It is, however, I think quite exciting from a macroeconomic perspective, and that maybe the fairly range-bound nature of the market reflects quite a lot of uncertainty about where the macroeconomy is heading. Have we seen the bottom in growth, or are we is the economy just going to track sideways to down over coming quarters? What is the RBI going to do with this likely new inflation targeting regime? Are we heading for further interest rate increases, or is the RBI now done? In brief, our view is that we are past the bottom in the growth cycle. We will see some improvement in growth. It's not going to be fantastic, but I think it is going to be stronger than many people anticipate in this coming fiscal year. At the same time, however, I think the RBI, after a pause now, will be hiking rates again from the September quarter of the 2014-15 fiscal year, and we're looking for another 75 basis points of hikes before the end of that fiscal year, as Rajan focuses on that 6% inflation number for January 2016.
So are you making a case that interest rates are unlikely to come down? In fact, according to your comments, interest rates should move higher.
Exactly, yes. I think they are more likely to move higher than lower. Obviously, one can debate whether that's appropriate or not, but it seems to us that Rajan is clearly in favor of inflation targeting. He's suggesting that he's not going to crush the economy in this attempt to get inflation down, but at the same time, he argues very forcefully that certainly over the long term, getting inflation down is almost a necessary condition for better growth. Again, one can debate whether that's right or not, but it doesn't matter. That's clearly what he believes, and clearly he believes inflation's too high. And I think the suggestion is that gradually, it will be gradual, and we probably will see a delay now for a few months, but the next move is far more likely to be up than down, in our view.
Robert, you know, the disappointing news this morning is the Farm Commissioner's warning, saying that perhaps monsoon next year is going to be subnormal. What would it mean for India's GDP, which is so agri-related, and what is your own estimate of the FY15 GDP target for us?
Well, I think weather forecasters, perhaps a bit like economists, don't always get their forecasts correct. So we need to take this with a bit of a pinch of salt. You know, I don't think we should be too fearful about that at this stage. I mean, it's still relatively early days. You know, we've got another 4 or 5 months before the monsoon is scheduled to begin. So let's wait and see on that. Of course, agriculture is much less important now as a driver of growth than it was. It's about 13% of GDP, although of course, you know, more than 50% of people still rely on agriculture, so you can get second round effects. I mean, we're assuming a reasonably normal monsoon in the current fiscal year, and that's along with other key drivers leaves us at a 6% GDP growth forecast. So we're very much, you know, at the top end of the consensus range.